Welcome back to another episode of Not Financial Advice. Today, we're going to be taking a look at $458 of stocks I purchased late last week. And so, we're going to get into each stock or ETF that I bought and say a word or two about why I purchased them and why I think they'll be a good long term investment. So, as we get into this, I'm going to ask you to go ahead and hit the like button and hit the subscribe button, and we'll get started. So, firstly, I purchased additional shares in Smith and Wesson. And so, if you take yourself to Google and type in SWBI, you can see a super cyclical stock that goes up hundreds of percent before an election and down multiple hundred percentage points after an election. And so, I had bought in a lot of this stock at the top of its price range. And that's something, I guess, a warning for new investors, something I would have told myself. Always be aware of when and how and why you learn about a stock. Chances are that if there's a lot of buzz around a stock, it's because it's been on a recent run. And so if you come across this new investment that's performing really well and everyone has positive things to say about it, just be aware of that because people don't talk about stocks when they're lower, except in the case of this channel where I am. And we're at the bottom of that historical price range based on things going on around the world. Most importantly, the fundamentals of this company, but also the very identifiable pattern at cyclicality. I believe this is an investment that will go up, and that's why I added a little bit here for Smith and Wesson. So, again, this was late last week. It's Sunday evening, recording this video. $20 into SCHD. When I first started investing, I thought I was the next Warren Buffett, so I didn't need to buy ETFs. I was too smart for that. Just look at ETFs as a cheat code. Billionaires like Ray Dalio buy ETFs. There's no shame in it. And so, you know, um, a market cap weighted ETF can be a good thing. In general, for the most part, the market is efficient, not always. But for the times that the market is efficient, that's when it's okay to have some nice exposure to a market cap weighted ETF. Um, and so, besides being market cap weighted, there's three other variables that go into this stock, things like profitability, things like low debt, high dividend growth. So I feel very good that any dollar I put into SCHD will be $2 in 5 or 7 years. So also with a nice about 3.6% dividend yield, I added here as well, unashamedly. So Coors, it's a defensive value stock. It's a consumer staple. You can make an argument it's a bit of a commodity, but I always thought that Coors Light tasted better than Bud Light. And fortuitously, I'd been in this position before the recent political controversy. So I own this across a few different portfolios. Pretty sure I've had some nice returns on it. But its price had been dragged down when the company had suffered some cyber attacks. And, they're not the only company that's had to deal with that. But fundamentals look good. I think the stock is fundamentally undervalued. I like consumer defensive. I'm going to have exposure to the growthiest parts of the market, but being a bear, I'm 100% invested. So I stay in some defensive names, and I feel very good about the future of this investment over the next 5, 7, 10 years. As a reminder, if you haven't already, I'm going to ask you to like the video and subscribe to the channel, and we're going to look at the rest of these investments placed. So here we have an investment made in Tyson, not too dissimilar from the thesis on Molson Coors or TAP. So Tyson is an American producer of meat, beef, chicken, poultry. Um, Controversial opinion, humans need protein, likely meat, but certainly protein. As the world, this is a company that does a lot of exports. And so as the world grows, um, humans need protein. And this is a near monopolistic company in that space. Um, Don't have a great personal feeling about this company. Um, it's a commodity. I don't think the quality of their food is that high. It's a commodity, but it is a business on a cash flow basis. I think it's undervalued, probably for a lot of the other reasons. People tend to look for healthier options here domestically, but I'm sort of looking big picture, including internationally, and in a defensive term, I think the stock's undervalued, and I think at some point its value will be unlocked over the next 20 years. It's not going anywhere, so I'm buying it. I'm adding to it. Um, so Alphabet, this is Google. Um, the thesis on this is one of my higher conviction bets. The thesis on this is that entertainment is a big deal in the 21st century. Um, and what makes entertainment a big deal is advertising. And so advertising is all about being able to put a targeted message to a specific audience, where you have a lot of eyeballs that are able to see that message. And so it's true in my own life. I waste so much time, more so consuming YouTube than making YouTube content, but I spend so much time on YouTube. Um, I like YouTube a lot. It serves good content. It's user friendly. Spend a lot of time on YouTube watching advertisements, skipping advertisements, and I think that Alphabet is dominant not only in streaming through YouTube, but also in search for Google Chrome. And so I think it's fairly valued, and I don't think it's getting knocked off anytime soon. Um, and so I see growth in this company, but I think even, as its growth phase might settle down in 10 years, I think it'll end up transitioning to a dividend paying blue chip, that I'm happy to own and add to. So we added to Alphabet. Same deal with Meta. I feel very similar with Meta as I do to Tyson. I detest the product. Um, but, some people are able to use Facebook to keep up with friends and family, and that's a nice thing. But other demographics, uh, use Instagram and in a certain way, it can be less toxic, or in other cases more toxic. They also own WhatsApp, which is very popular internationally. And so just sort of the distasteful taste that Facebook leaves in people's mouth, I think has led the stock to be undervalued. It's starting to approach fair value now. But I hold this across multiple portfolios, and I have some gains over 100% um, in a similar sized position in a different portfolio. So I'm averaging up into it, but my overall cost basis is quite a bit lower than where it is, and so I think this is a good growth name to be in for the moment. Um, looks like I liked it so nice, I bought it twice. No, this will be SCHD's international cousin, SCHY. Okay, so same deal with SCHD. This is international value stocks. So things like Canadian banks or European medical companies, French consumer discretionary, European tobacco, basically well established dividend paying countries, mostly from the developed world. But, it's a large cap international value and dividend paying ETF. Looking at international equities, there are whole decades when international outperforms. And in my research, international value performs international blend. So I like SCHY a lot. I like the construction of it. It's another so-called cheat code, that I've added in my portfolio to help level out its performance and improve its risk adjusted returns, whatever that means. I think that's what I'm doing. So more added to SCHY as well. Now, also I've added to another ETF, which is aerospace and defense. So these are war stocks. Um, for the most part, in the large cap part of this sector, these are free cash flow positive dividend paying stocks. A lot of the money is coming from the government. And so it is an apples to orange comparison, but a lot of the funding for these companies comes from the US government. And I look at it with a certain level of security. I did not buy this initially because there are multiple wars going on. I already owned it. But looking over the last two or so decades, this sector has underperformed drastically. And so I think the sector on the whole is undervalued, and it's a defensive sector of the S&P 500. I think that it's likely that you can see outperformance in this sector over the next 10 years. Maybe I'm right, maybe I'm wrong, but that's what I'm going with. So, um, bank stocks, what's there to say about that? This should include Berkshire Hathaway. It should include, probably the best operating bank stock out there is probably JP Morgan Chase. Of course, you also have Bank of America, which is one of Warren Buffett's top holdings. So I don't understand the sector, but I know that bankers are in the business of taking your money and investing it at a higher rate than they give to you, and that bankers are rich and successful. And I'd like to be also. I don't understand the industry fully. I am a little bit fuzzy about where along economic cycle we even are or when it performs the best. But this is a dividend paying sector. It's one I think that's good to have exposure to. And I do have the sense that banks are more secure after what happened in 2007 and 2008. So I added here as well. So additionally, healthcare. What can I say? I think the thesis on this is that number one, the world's getting older. Old people require more healthcare. I also think that this is a large cap blend ETF. So there's parts of it that are both value as well as growth. You know, the fact of the matter is that science is a big part of healthcare, and because of that, we're in a defensive sector of the S&P. But I think there's some if you just look at some of these recent weight loss drugs, I think there's a lot of technological catalysts that can propel this sector forward with lower overall risk. And so I think this is a big growth opportunity over the next 20 years. And so I very happily added to my position in the Vanguard Healthcare ETF here as well. So utilities, long story short, people pay for the most part their gas and light bill. And it can be seen as a replacement for bonds in the sense that it pays a steady dividend, and people looking for income or dividends or yield, oftentimes they'll go to bonds. But if they don't go to bonds and they go for income or dividends in equities, utilities have the least correlation with the market. So they move in the same direction of the market, I believe 0.50% of the time. So when the market zigs, utilities often zag while paying a nice dividend along the way. So I was happy to add there. Williams Sonoma, my baby, one of my highest conviction bets. The idea is that affluent upper class women are going to buy uh, French cast iron skillets no matter what the economy is doing. And so this is a consumer discretionary stock, but they deal in a lot of high end homeware, be it in the kitchen space. Also, they own a brand called Pottery Barn, which apparently um, upscale older ladies really love. A friend of my mom's, uh, rather a mother of one of my friends, loves going to Pottery Barn, whatever. Balance sheet is great. This is definitely an undervalued stock. I think it's ranked like 50% this year. I've been in this for going on 2.5, 3 years. So always happy to add to Williams Sonoma. Foot Locker, just this is just probably not a good idea. This is a cigar butt. It's good for one last puff. Um, this is very much so Benjamin Graham type stock. I think it's about 50% undervalued. They're in malls recently. People bought a lot of expensive sneakers in 2020, 2021, less so now. Malls are becoming less popular, but I think it's a turnaround story. It's led by Mary Dillon, who's the former CEO of Ulta, which was a market-beating stock in the S&P 500. And so this is probably one of my riskier investments, but I think this is good for one last puff. And I really hope that when I make a double on my money on this, if that were to happen, that I'm wise enough to exit the position, which is not something I often do trading, but I figured what the heck. So we have that in there as well. And then Best Buy. Right now, people are having a hard time buying things that require financing. But if someone's fridge goes out, they're going to go buy a new fridge. And the trend for retail is online. But I think when it comes to things like fridges and washers and dryers, and to an extent, big screen TVs, I think mom wants to go check out how this appliance looks in person. And Best Buy is a fundamentally undervalued mid cap value stock with some really nice growth metrics and strong leadership. So I think Best Buy is super undervalued. I own a lot of it. It's a high conviction bet. I'm down on it still, averaging down, pays a large dividend. I'm very happy to be adding to this position. Walgreens Boots Alliance. Unfortunately, this one's probably a little bit more like Foot Locker. Um, it's a company I've given a lot of money to throughout my life. Um, I think that it's got some brand equity. I think that they um, have some really good locations with foot traffic or vehicle traffic. It is a retailer. They are traditionally undervalued because people still remember losing all their money in Sears and Kmart. But with a little bit of more so of that exposure to medical, I think it's undervalued on a free cash flow basis. It may or may not be a value trap, but I'm just way too deep into it. So that's probably a horrible thing. And then Ulta Beauty. So this is a one I feel really good about. It's a retailer of beauty products. Like I said in the past, this retailer has beaten the market. Fundamentals look great. It's trading at about fairly valued right now. But this is a company that is popular. Women will always go and buy makeup even if there's a fire, even if it's the apocalypse, or in good times. Women are always buying makeup, and so beauty is considered part of the consumer defensive category of the S&P. This is a really well run company with a great balance sheet that's popular with women of all ages, from very young women to older women. So love this stock. Um, Additionally, had a small contribution to the U.S. total stock market through my employer. And then lastly, I bought some more SCHD just to round everything off. So if you stuck with me this far, I'll ask you to like the video and subscribe. Thanks so much for tuning in, and I will see you on the next one.